Question 1. An individual managing a hedge fund for accredited investors explicitly states that he provides investment advice tailored to each client's specific financial situation and charges asset-based fees. Under the Investment Advisors Act of 1940, how should this individual or his firm be classified? A. Exempt from registration due to serving only accredited investors. B. Required to register as a broker-dealer, not an investment advisor. C. Required to register as an investment advisor. D. Exempt from registration if assets under management are below $25 million. Answer: C. Required to register as an investment advisor. This individual meets the definition of an investment advisor under the Investment Advisors Act of 1940 because he provides investment advice as a regular part of his business, for compensation, asset-based fees, and tailors it to client-specific situations. While accredited investors are often involved in private funds, this does not exempt the advisor from registration if they meet the definitional criteria. The private fund advisor exemption might apply to SEC registration based on AUM and client type, but the fundamental classification as an investment advisor remains. Question 2. A state-registered investment advisor. IA is also a registered representative, RR, of a broker-dealer. One of the IA's advisory clients wishes to purchase a mutual fund recommended by the IA, and the IA plans to execute the trade through their affiliated broker-dealer, receiving a commission. What is the most appropriate action for the IA? A. Proceed with the trade, as dual registration is permitted and all services are legitimate. B. Advise the client to execute the trade with a different, unaffiliated broker-dealer. C. Disclose the conflict of interest and the commission received, obtain written client consent, and ensure the transaction is in the client's best interest. D. Decline to execute the trade through their affiliated broker-dealer to avoid any appearance of conflict. Answer: C. Disclose the conflict of interest and the commission received, obtain written client consent, and ensure the transaction is in the client's best interest. When an investment advisor is duly registered as a registered representative and intends to execute a transaction through an affiliated broker-dealer for which they will receive a commission, a significant conflict of interest arises. The IA has a fiduciary duty to act in the client's best interest, which includes ensuring full and fair disclosure of all material facts. Therefore, the most appropriate action is to fully disclose the conflict, the compensation received, and obtain the client's written consent before executing the trade, while always ensuring the recommendation and transaction are suitable and in the client's best interest. Question 3. An investment advisor representative, IAR, is discussing the benefits of diversification with a client. The IAR explains that combining assets with low or negative correlation can help reduce overall portfolio risk for a given level of return. This concept is most directly associated with which of the following investment theories? A. Efficient market hypothesis, EMH. B. Modern portfolio theory, MPT. C. Capital asset pricing model, CAPM. D. Behavioral finance. Answer: B. Modern portfolio theory, MPT. The explanation provided by the IAR directly describes a core principle of modern portfolio theory, MPT. MPT, developed by Harry Markowitz, posits that investors can construct portfolios to maximize expected return for a given level of market risk, or conversely, minimize risk for a given level of expected return, by combining assets with imperfect correlations. This focus on diversification to optimize the risk-return trade-off is central to MPT. Efficient market hypothesis concerns information and pricing efficiency, CAPM focuses on asset-specific required returns, and behavioral finance explores psychological influences on investment decisions. Question 4. A client is considering purchasing a municipal bond for tax-free income. The bond has a par value of $5,000, a coupon rate of 4%, and is currently trading at 105. It matures in 10 years and is callable in 5 years at 102. Which yield would be most relevant for an investor considering this bond, assuming interest rates are expected to decline? A. Current yield. B. Yield to maturity, YTM. C. Yield to call, YC. D. Nominal yield. Answer, C. Yield to call, YC. When interest rates are expected to decline, issuers are more likely to call bonds to refinance at lower rates. Since the bond is trading at a premium, 105, and is callable, the yield to call, YC, is the most relevant yield to consider. YTC calculates the yield if the bond is called at its first call date, reflecting the investor's return in the worst-case scenario, for a premium bond, which is being called early. Current yield and nominal yield do not account for the bond's premium or call features, while YTM assumes the bond is held to maturity, which is less likely if rates fall. Question 5. An investment advisor with custody of client funds or securities must arrange for a surprise annual examination by an independent public accountant, unless which of the following conditions applies? A. The advisor is federally registered with the SEC and has more than 100 clients. B. The advisor has less than $1 million in assets under management. C. The advisor has custody solely due to direct fee deduction from client accounts. D. The advisor is a sole proprietorship and keeps all records securely locked. Answer, C. The advisor has custody solely due to direct fee deduction from client accounts. Under the custody rule, an investment advisor generally must undergo a surprise annual examination by an independent public accountant if it has custody of client assets. However, an exception to the surprise examination requirement exists if the advisor has custody solely because it has the authority to deduct advisory fees directly from client accounts and returns all client funds and securities within 3 business days of receipt. In such a scenario, while the advisor still technically has custody, the specific risks addressed by the surprise exam are mitigated by the limited nature of that custody. The other options do not provide an exemption from this specific rule. Question 6. A client is concerned about inflation eroding the purchasing power of their fixed income investments. Which of the following bond characteristics would offer the best protection against unexpected inflation? A. Long-duration municipal bonds with a high credit rating. B. Zero-coupon bonds purchased at a deep discount. C. Treasury inflation-protected securities, TIPS. D. High-yield corporate bonds with a floating interest rate. Answer, C. Treasury inflation-protected securities, TIPS. Treasury inflation-protected securities, TIPS, are explicitly designed to protect investors from inflation. Their principal value adjusts semi-annually based on changes in the Consumer Price Index, CPI, and the coupon payments are then calculated on this adjusted principal, providing direct protection against inflation. While floating-rate bonds can offer some protection, TIPS offer a more direct and reliable hedge against inflation. Long-duration bonds are highly sensitive to interest rate changes, which often correlate with inflation, and zero-coupon bonds are also highly sensitive to interest rate fluctuations. Question 7. Which of the following activities by an investment advisor representative, IR, would most likely constitute an unethical business practice related to client suitability? A. Recommending a diversified portfolio of index funds to a client with a moderate risk tolerance. B. Investing a significant portion of an elderly client's retirement savings in highly speculative microcap stocks. C. Discussing the tax implications of various investment strategies with a client. D. Encouraging a client to rebalance their portfolio annually to maintain their target asset allocation. Answer, B. Investing a significant portion of an elderly client's retirement savings in highly speculative microcap stocks. Investing a significant portion of an elderly client's retirement savings in highly speculative microcap stocks is a classic example of an unethical business practice related to suitability. This action demonstrates a clear disregard for the client's financial situation, investment objectives, typically preservation of capital and income for retirees, and risk tolerance. IARs have a fiduciary duty to recommend investments that are suitable for the client, which includes considering age, financial status, investment experience, and risk tolerance. The other options represent sound advisory practices. Question 8. An investment advisor suggests that a client invest in a private equity fund, emphasizing the potential for high returns and limited public market correlation. However, the advisor fails to adequately explain the illiquidity, extended lockup periods, and high fees associated with such funds. This omission would most likely be considered a violation of the advisor's A. Duty of best execution. B. Record-keeping requirements. C. Fiduciary duty of loyalty. D. Anti-fraud provisions. Answer, C. Fiduciary duty of loyalty. The advisor's failure to fully disclose the material risks, illiquidity, and fees associated with the private equity fund, while emphasizing only the benefits, is a violation of their fiduciary duty of loyalty. This duty requires the advisor to act solely in the best interest of the client and to provide full and fair disclosure of all material facts, especially regarding conflicts of interest or significant risks of recommended investments. While it could also be an anti-fraud violation, the specific omission of critical negative aspects points directly to a breach of the duty of loyalty to provide complete and unbiased advice. Question 9. Under the Uniform Securities Act, which of the following individuals would not be excluded from the definition of an investment advisor representative, IAR? A. An individual who provides general market commentary in a widely distributed financial newsletter. B. A person who provides only clerical or ministerial functions for an investment advisor. C. A broker-dealer's registered representative who provides investment advice solely incidental to the conduct of their business as a broker-dealer and receives no special compensation for the advice. D. An individual employed by a federal covered investment advisor who solicits advisory clients in the state. Answer, D. An individual employed by a federal covered investment advisor who solicits advisory clients in the state. An individual employed by a federal covered investment advisor who solicits advisory clients in the state is explicitly included in the definition of an investment advisor representative, IR, under the Uniform Securities Act. Even though the advisor is federal covered, the IAR generally still needs to register at the state level. The other options describe individuals who typically qualify for exclusions from the definition of an IAR, publishers, those performing clerical tasks, and broker-dealers whose advice is solely incidental and not specially compensated. Question 10. A client inherited a substantial sum in a concentrated stock position. The client is concerned about potential estate taxes upon their death and wants to minimize the tax burden for their heirs. While the client desires to control other personal assets, they are open to planning tools that require relinquishing control over specific assets for estate tax efficiency. Which of the following estate planning tools would an IAR most appropriately suggest exploring with an estate planning attorney for minimizing estate taxes? A. A revocable living trust. B. An irrevocable life insurance trust, ILIT. C. A simple will. D. A durable power of attorney. Answer, B. An irrevocable life insurance trust, ILIT. An irrevocable life insurance trust, ILIT, is specifically designed to remove life insurance proceeds from the grantor's taxable estate, thereby reducing potential estate taxes. While placing assets into an irrevocable trust requires relinquishing control over those specific assets, it is a powerful tool for estate tax minimization. For clients primarily focused on reducing estate taxes, especially on significant assets like a concentrated stock position, by providing liquidity to pay taxes on those assets, an ILIT is a highly effective strategy to discuss with an estate planning attorney. A revocable living trust avoids probate, but its assets are still included in the grantor's estate for tax purposes. A simple will directs asset distribution but doesn't offer estate tax advantages, and a durable power of attorney grants decision-making authority but isn't an estate tax planning tool. Question 11. An investment advisor. IA charges a quarterly fee for managing client portfolios. The IA recently decided to move its office to a new location. Under the Investment Advisors Act of 1940 and NASAA rules, what action is required regarding the IA's Form ADV? A. The IA must amend Form ADV within 90 days of the end of its fiscal year. B. The IA must file an other than annual amendment to Form ADV promptly. C. No amendment is required unless the move impacts client access. D. The IA must notify existing clients in writing within 30 days of the move. Answer, B. The IA must file an other than annual amendment to Form ADV promptly. A change in the investment advisor's principal office location is considered a material change that requires an other than annual amendment to Form ADV. Both SEC and NASAA rules require advisors to amend their Form ADV promptly to reflect any material changes. While clients should eventually be aware of the new address, the primary regulatory requirement is the prompt filing of the updated Form ADV to reflect this material information. The annual updating amendment is for routine updates at fiscal year end, but material changes require prompt action. Question 12. A client invests $10,000 in a mutual fund with a net asset value, NAV, of $19.00 and a 5% front-end sales charge, low D. If the client reinvests all dividends, what is the client's initial number of shares purchased? A. 500 shares. B. 526, 32 shares. C. 475 shares. D. 531, 58 shares. Answer. A. 500 shares. To calculate the initial number of shares purchased, first determine the net investment amount after the sales charge. If the sales charge is 5% of the total amount invested, then the amount invested in shares is $10,000 asterisk 1005 equals $9,500. Given the net asset value, NAV, of $19.00 per share, the number of shares purchased is $9,500/$19.00 equals 500 shares. The dividend information is a distractor for the initial share calculation. Question 13. An investment advisor representative, IAR, is evaluating a company using fundamental analysis. Which of the following ratios would be least useful in assessing the company's short-term liquidity? A. Current ratio. B. Quick ratio, acid test ratio. C. Debt-to-equity ratio. D. Cash ratio. Answer, C. Debt-to-equity ratio. The debt-to-equity ratio is primarily used to assess a company's financial leverage and long-term solvency, indicating how much debt the company is using to finance its assets relative to the value of shareholders' equity. While important for overall financial health, it is not a direct measure of short-term liquidity. In contrast, the current ratio, quick ratio, and cash ratio are all direct measures of a company's ability to meet its short-term obligations using its most liquid assets. The practical takeaway is to understand which financial ratios provide insights into different aspects of a company's financial health. Question 14. A client approaches an investment advisor representative, IR, seeking to invest specifically in companies that demonstrate strong environmental, social, and governance, ESG, practices. The IAR, however, recommends a broad market index fund, stating it provides better diversification. Which ethical consideration is the IAR most likely failing to uphold? A. Duty of best execution. B. Fair dealing with clients. C. Adherence to the brochure rule. D. Respecting client investment objectives. Answer: D. Respecting client investment objectives. The IAR is failing to respect the client's specific investment objectives, which explicitly include ESG criteria. While diversification is generally a sound investment principle, an IAR has a fiduciary duty to consider and attempt to meet the client's stated goals, including their ethical or values-based preferences. Simply overriding the client's specific request for an ESG-focused investment with a generic recommendation, without fully exploring ESG-compliant options, demonstrates a lack of respect for their objectives. This highlights the importance of tailoring advice to the client's unique profile, beyond just financial metrics. Question 15. A new client wants to transfer their account to a new investment advisor. IA. The client informs the IA that they have discretionary authority with their previous IA. What is required for the new IA to begin exercising discretionary authority over the client's account? A. Oral consent from the client, followed by written confirmation within 10 business days. B. A fully executed written power of attorney from the client. C. Confirmation from the previous IA that discretionary authority was granted. D. The client's verbal consent, as they previously granted discretionary authority. Answer: B. A fully executed written power of attorney from the client. For an investment advisor. IA. To exercise discretionary authority over a client's account, a fully executed written power of attorney or investment advisory contract specifically granting such authority is always required. Verbal consent, even if previously granted to another advisor, is insufficient. This written authorization ensures clarity, protects both the client and the advisor, and is a fundamental regulatory requirement for discretionary trading. It's a critical component of establishing a fiduciary relationship where the advisor makes investment decisions on the client's behalf. Question 16. Which of the following actions by a state-registered investment advisor representative, IR, would not trigger registration in a new state under the Uniform Securities Act? A. Soliciting advisory clients in the new state. B. Establishing an office in the new state. C. Having 4 existing retail clients who are residents of the new state and to whom the IAR provides advice without an office in that state. D. Supervising another IAR who has an office in the new state. Answer: C. Having 4 existing retail clients who are residents of the new state and to whom the IAR provides advice without an office in that state. Under the Uniform Securities Act, an IAR typically triggers registration in a state if they have an office in the state or if they have more than the de minimis number of retail clients, usually 5, who are residents of the state and to whom they provide advice. Having 4 retail clients, without an office in the state, falls under the common de minimis exemption, meaning registration is generally not required. Soliciting clients, establishing an office, or supervising another IAR with an office in the state would all trigger registration requirements. Question 17. Under what circumstances would a state-registered investment advisor, IA, be required to provide a balance sheet with its Form ADV Part 2A, brochure? A. If the IA maintains custody of client funds or securities. B. If the IA has discretion over client accounts but does not maintain custody. C. If the IA is federally registered with the SEC, regardless of custody. D. Only if the IA charges performance-based fees. Answer: A. If the IA maintains custody of client funds or securities. A state-registered investment advisor. IA, is generally required to include a balance sheet with its Form ADV Part 2A, brochure, if the IA maintains custody of client funds or securities. This requirement ensures transparency about the advisor's financial solvency when handling client assets. While IAs with discretion must disclose this fact, it does not automatically trigger the balance sheet requirement unless custody is also involved. Federal covered advisors have different balance sheet requirements, and performance fees do not directly mandate a balance sheet in the brochure itself, though they necessitate certain financial standing for the client. Question 18. An investment advisor, IA, has decided to switch from using a third-party broker for client trades to self-clearing, thereby effectively gaining custody of client assets. What is the most immediate action required of the IA under the custody rules? A. Notify all clients in writing of the change in custody arrangements within 30 days. B. Update Form ADV to reflect the change in custody and obtain a surprise annual audit. C. Obtain a surety bond equal to $35,000 for client protection. D. Request written consent from each client for the new custody arrangement. Answer: B. Update Form ADV to reflect the change in custody and obtain a surprise annual audit. When an IA takes on custody of client assets, it triggers significant regulatory obligations under the custody rule, most notably the requirement to undergo an annual surprise examination by an independent public accountant. Furthermore, the IA must promptly amend its Form ADV to reflect that it now has custody. While client notification is important, and a surety bond might be required under state law in specific circumstances, e.g., if the IA has custody and minimal net worth, the immediate and universal regulatory requirements are updating Form ADV and arranging for the surprise audit. Question 19. A portfolio manager for a large institutional client believes the market is overvalued and anticipates a significant correction. To hedge the portfolio's equity exposure, she decides to implement a strategy involving options. Which option strategy would be most appropriate for a broad market hedge against a market downturn? A. Buying calls on individual stocks. B. Selling covered calls on the portfolio's existing holdings. C. Buying protective puts on specific large-cap stocks. D. Buying S&P 500, SPX, index puts. Answer: D. Buying S&P 500, SPX, index puts. To achieve a broad market hedge against a significant market downturn, buying S&P 500, SPX, index puts is the most appropriate strategy. SPX options are broad-based index options that provide exposure to the overall market, making them effective for hedging an entire equity portfolio. Buying calls profits from a rise, selling covered calls offers limited downside protection while capping upside, and buying protective puts on individual stocks would only hedge specific holdings, not the overall market exposure. SPX puts offer direct, efficient, and cost-effective broad market downside protection. Question 20. Which of the following scenarios would most likely exempt an investment advisor? IA. From SEC registration under the Investment Advisors Act of 1940. A. The IA has clients in 15 different states, with $120 million in assets under management, AUM. B. The IA exclusively advises insurance companies and has $150 million in AUM. C. The IA is an advisor to a private fund with less than $150 million in AUM. D. The IA provides advice only to charitable organizations and has $110 million in AUM. Answer: C. The IA is an advisor to a private fund with less than $150 million in AUM. An advisor to a private fund with less than $150 million in assets under management, AUM, is generally exempt from SEC registration under the Private Fund Advisor exemption. This is a specific provision designed for advisors dealing with sophisticated investors in private funds below a certain threshold. Advisors with $100 million or more in AUM, or $110 million for buffer, typically register with the SEC unless an exemption applies. The other options generally describe scenarios where an IA would be subject to SEC registration if their AUM threshold is met, as the client types do not automatically provide an exemption from SEC registration based on the AUM mentioned. Question 21. A client has a lump sum to invest for retirement in 30 years and prioritizes long-term growth. The client has a high-risk tolerance and wants to minimize current income taxes. Which of the following investment vehicles would be most suitable? A. A portfolio heavily weighted towards high-dividend preferred stocks in a taxable account. B. A municipal bond ladder in a Roth IRA. C. Growth-oriented equity mutual funds within a traditional IRA. D. A balanced fund focusing on income generation in a 401(k) plan. Answer, C. Growth-oriented equity mutual funds within a traditional IRA. Growth-oriented equity mutual funds within a traditional IRA are highly suitable for a client with a long time horizon, high-risk tolerance, and a desire to minimize current income taxes. The traditional IRA allows for tax-deductible contributions, reducing current taxable income, and tax-deferred growth, with distributions taxed at retirement. Growth-oriented equities align with the long-term growth objective and high-risk tolerance. High-dividend preferred stocks generate current taxable income, municipal bonds focus on tax-free income, not growth, and a balanced fund might be too conservative for high-risk tolerance and aggressive growth goals. Question 22. An investment advisor representative, IR, discovers that a client has been diagnosed with a severe cognitive impairment. The client has not updated their durable power of attorney for financial matters, and their son expresses concern about their ability to make sound financial decisions. What is the IAR's most appropriate course of action? A. Immediately freeze the client's account to prevent potential mismanagement. B. Continue to follow the client's instructions unless formally declared incompetent by a court. C. Contact the son to request a new power of attorney be established, overriding the client's current directives. D. Attempt to contact the individual named as the client's emergency contact or trusted contact person, if designate D, and if necessary, follow the firm's policies for suspected elder abuse or diminished capacity. Answer, D. Attempt to contact the individual named as the client's emergency contact or trusted contact person, if designate D, and if necessary, follow the firm's policies for suspected elder abuse or diminished capacity. When an IAR suspects a client has diminished capacity, the most appropriate initial action is to follow firm policies, which typically include attempting to contact the client's designated trusted contact person or emergency contact. Freezing accounts or overriding client instructions without proper legal authority or formal declaration of incompetence could lead to legal issues. The IAR has a responsibility to protect the client while respecting their autonomy. Escalating through the firm's established protocols for diminished capacity, which may include legal consultation, is key. Directly contacting the son to override current directives is not appropriate without established legal authority. Question 23. Which of the following statements regarding the brochure rule, Form ADV Part 2, is true? A. It must be delivered to clients at least annually, regardless of material changes. B. It requires advisors to disclose all criminal convictions of their employees over the past 5 years. C. It must be delivered to prospective clients at least 48 hours before entering into an advisory contract, or at the time of contract if a free look period is offered. D. It is only required for federally covered investment advisors, not state-registered advisors. Answer, C. It must be delivered to prospective clients at least 48 hours before entering into an advisory contract, or at the time of contract if a free look period is offered. The brochure rule requires an investment advisor to deliver Form ADV Part 2, the brochure, to prospective clients at least 48 hours before entering into an advisory contract, or at the time of entering the contract if the client has a right to terminate the contract without penalty within 5 business days, a free look period. It also requires annual delivery or an annual offer to deliver, and disclosure of material disciplinary events, not necessarily all criminal convictions of employees. The rule applies to both federally covered and state-registered investment advisors, with specific state variations. Question 24. An investment advisor representative, IAR, is developing an asset allocation strategy for a new client. The client is 45 years old, plans to retire at 65, has a moderate risk tolerance, and seeks long-term capital appreciation with some income. Which asset allocation approach would be least suitable for this client? A. A balanced portfolio with 60% equities and 40% fixed income. B. A portfolio primarily invested in short-term money market instruments and certificates of deposit, CDs. C. A growth-oriented portfolio with a significant allocation to large-cap domestic and international equities. D. A target date fund aligned with the client's retirement year. Answer, B. A portfolio primarily invested in short-term money market instruments and certificates of deposit, CDs. A portfolio primarily invested in short-term money market instruments and CDs would be least suitable for this client. With a 20-year time horizon until retirement and a goal of long-term capital appreciation, such a conservative allocation would likely fail to provide sufficient growth to meet retirement goals, and would significantly expose the client to inflation risk. While the client has a moderate risk tolerance, money market instruments are typically reserved for very short-term needs or extremely low-risk profiles, not long-term growth. The other options align much better with the client's age, time horizon, and objectives. Question 25. A portfolio manager is evaluating 2 investment strategies. Strategy A has a higher average return but also a higher standard deviation than strategy B. If both strategies have the same correlation to the market, and the manager uses the Sharpe ratio to compare them, which factor is not directly accounted for by the Sharpe ratio? A. Risk-free rate of return. B. Standard deviation of portfolio returns. C. Excess return over the risk-free rate. D. The beta of the portfolio. Answer, D. The beta of the portfolio. The Sharpe ratio measures risk-adjusted return by comparing a portfolio's excess return minus the risk-free rate, to its total risk, as measured by standard deviation. The formula is, portfolio return, risk-free rate, / portfolio standard deviation. Therefore, it directly accounts for the risk-free rate, standard deviation, and excess return. The beta of the portfolio, which measures systematic risk or volatility relative to the market, is not directly used in the Sharpe ratio calculation. Instead, standard deviation captures total risk, both systematic and unsystematic. The practical takeaway is to understand when to use different risk-adjusted return measures, e.g., Sharpe for total risk, Trainer for systematic risk. Question 26. Under the Uniform Securities Act, an investment advisor, IA, may charge a performance-based fee only if the client is A. An accredited investor. B. A qualified client. C. A sophisticated investor. D. An institutional client. Answer, B. A qualified client. Under both SEC rules and NASAA model rules, an investment advisor may generally charge a performance-based fee only to a qualified client. A qualified client is typically defined as an individual or company that has at least $1 million under management with the advisor or has a net worth of more than $2 million, excluding the value of their primary residence. While accredited and institutional clients often meet these criteria, the specific regulatory term that permits performance fees is qualified client. This ensures that only clients with sufficient assets and financial sophistication are exposed to the unique risks of performance fee arrangements. Question 27. An investment advisor representative, IR, maintains a personal brokerage account where they trade securities identical to those recommended to clients. Which of the following best describes the IAR's obligation regarding these personal trades? A. The IAR is generally prohibited from trading securities that are also recommended to clients. B. The IAR must ensure their personal trades do not disadvantage client accounts, and they must report these trades to their firm. C. The IAR only needs to disclose their personal trading policy in Form ADV, not individual trades. D. The IAR can trade freely in their personal account as long as it does not involve insider information. Answer: B. The IAR must ensure their personal trades do not disadvantage client accounts, and they must report these trades to their firm. IARs have a fiduciary duty to clients, and their personal trading activities must not conflict with client interests. This includes preventing front-running or other practices where the IAR benefits at the client's expense. Therefore, IARs are generally required to report their personal securities transactions to their firm, often through a pre-clearance or periodic reporting system, to ensure compliance with ethical guidelines and prevent potential conflicts of interest. The firm's compliance procedures would then ensure that personal trades do not disadvantage clients. Question 28. Which of the following actions is a state-registered investment advisor not permitted to do regarding client testimonials and endorsements? A. Use a written testimonial from an existing client who is an accredited investor, as long as it's not misleading. B. Use a paid endorsement from a celebrity without disclosing the compensation arrangement. C. Use an unsolicited positive review from a client on a third-party social media platform, if it meets specific conditions. D. Provide compensation to a third-party solicitor who refers clients, provided all disclosures are made and a written agreement is in place. Answer: B. Use a paid endorsement from a celebrity without disclosing the compensation arrangement. The use of a paid endorsement from a celebrity without clearly and prominently disclosing the compensation arrangement is explicitly prohibited by both SEC and NASAA rules regarding testimonials and endorsements. Investment advisors must ensure that any testimonial or endorsement clearly indicates whether the person giving it is a client and whether they are being compensated for it. Failure to disclose compensation is considered a deceptive practice. While compensated solicitors are allowed under specific conditions, compensated endorsements without disclosure are a violation. The practical takeaway is that transparency regarding compensation for promotional material is paramount for investment advisors. Question 29. A client calls their investment advisor representative, IR, with an urgent request to sell a significant portion of their bond portfolio because they believe interest rates will rise sharply, leading to bond price declines. The IAR, based on their research, believes rates will remain stable. The client insists on the trade. What is the IAR's most appropriate action? A. Execute the trade immediately, as the client's instructions must always be followed. B. Refuse the trade, as the IAR believes it is unsuitable and against the client's best interest. C. Explain the IAR's differing view, highlight potential consequences, document the client's insistence, and then execute the trade. D. Recommend investing the proceeds into a high-risk equity fund to capitalize on potential growth if the client is so convinced rates will rise. Answer: C. Explain the IAR's differing view, highlight potential consequences, document the client's insistence, and then execute the trade. As a fiduciary, an IAR must act in the client's best interest. When a client insists on a trade that the IAR believes is unsuitable, the IAR should clearly explain their professional opinion, highlight the potential risks and consequences of the client's desired action, and diligently document this discussion and the client's continued insistence. After fulfilling the disclosure and suitability discussion, the IAR must typically still execute the client's explicit instructions for non-discretionary accounts. Refusing the trade outright or making an equally unsuitable counter-recommendation is generally inappropriate unless the trade is illegal or directly contrary to their established investment objective. Question 30. Which of the following statements regarding the taxation of qualified retirement plan distributions is generally true? A. All distributions from a Roth IRA are tax-free if the account has been open for at least 5 years and the owner is 59.5 or older. B. Distributions from a traditional IRA are always tax-free if the owner is over 59.5. C. Employer contributions to a 401(k) are taxed in the year they are made. D. All distributions from a qualified retirement plan are subject to a 10% early withdrawal penalty if taken before age 59.5. Answer. A. All distributions from a Roth IRA are tax-free if the account has been open for at least 5 years and the owner is 59.5 or older. Distributions from a Roth IRA are generally tax-free and penalty-free if the account has been open for at least 5 years, that a 5-year rule, and the owner is at least 59.5 years old, is disabled, or is using the funds for a first-time home purchase. This is a key advantage of Roth accounts due to their after-tax contributions. Distributions from traditional IRAs are taxed as ordinary income if contributions were tax-deductible. Employer contributions to 401(k) escrow tax-deferred, and while a 10% early withdrawal penalty exists for qualified plans, there are numerous exceptions, e.g., death, disability, substantially equal periodic payments, medical expenses. Question 31. A financial metric that measures the amount of current assets available after all current liabilities are paid, and is often used to assess a company's short-term liquidity, is known as A. Working capital. B. Current ratio. C. Debt-to-equity ratio. D. Net profit margin. Answer. A. Working capital. Working capital is calculated as current assets minus current liabilities. It represents the capital available to a business for its day-to-day operations and provides a direct measure of its short-term liquidity. A positive working capital indicates that a company has sufficient liquid assets to cover its short-term obligations. While the current ratio also assesses liquidity, it's a ratio, not an absolute amount. The debt-to-equity ratio measures leverage, and net profit margin measures profitability. Question 32. An investment advisor representative, IAR, is discussing alternative investments with a high-net-worth client. The client is interested in the potential for uncorrelated returns but is concerned about liquidity. Which characteristic is most important for the IAR to emphasize regarding typical alternative investments like private equity or hedge funds? A. Their strict regulatory oversight by FINRA. B. Their typically higher liquidity compared to traditional assets. C. Their complex fee structures and often limited transparency. D. Their guaranteed superior performance in bear markets. Answer, C. Their complex fee structures and often limited transparency. When discussing typical alternative investments like private equity or hedge funds, it is crucial for the IAR to emphasize their complex fee structures, e.g., 2 and 20, limited transparency, and often restrictive liquidity terms, e.g., lockup periods, gates. These are significant characteristics that differentiate them from traditional investments and directly impact investor experience and access to capital. While they may offer uncorrelated returns, they are generally not highly liquid, are less strictly regulated than public securities, and do not offer guaranteed superior performance. Full disclosure of these less desirable features is a key part of fiduciary duty. Question 33. Under the Uniform Securities Act, which of the following is not required to be included in an investment advisory contract? A. The services to be provided by the advisor. B. The term of the contract. C. A clause specifying that the contract can be assigned to another advisor without client consent. D. The amount of advisory fee and the method of its computation. Answer: C. A clause specifying that the contract can be assigned to another advisor without client consent. An investment advisory contract generally cannot be assigned to another investment advisor without the express consent of the client. This is a fundamental protection for advisory clients, as they are entering into a relationship of trust with a specific advisor. Therefore, a clause specifying that the contract can be assigned without client consent is explicitly prohibited and would not be included. The other items, services, term, and fee details, are all mandatory elements of an advisory contract under the Uniform Securities Act to ensure transparency and understanding. Question 34. A client holds a diversified portfolio of large-cap domestic equities and is concerned about protecting against a short-term, moderate decline in the overall market. Which of the following strategies would be the most cost-effective and efficient way to hedge this risk? A. Selling all equity holdings and reinvesting in money market funds. B. Purchasing put options on each individual stock in the portfolio. C. Selling S&P 500 futures contracts. D. Buying inverse ETFs that track the overall market. Answer: C. Selling S&P 500 futures contracts. Selling S&P 500 futures contracts is often the most cost-effective and efficient way to hedge a diversified portfolio of large-cap domestic equities against a short-term, moderate market decline. Futures contracts allow for broad market exposure with lower transaction costs and greater leverage than buying individual options or inverse ETFs for a large portfolio. Selling all equity holdings would involve significant transaction costs and miss any market rebound. Buying individual puts would be cumbersome and expensive for a diversified portfolio. Inverse ETFs have expense ratios and tracking error that might make them less efficient for a temporary hedge of a large portfolio. Question 35. An investment advisor, IA, regularly publishes a widely distributed newsletter containing general market commentary and recommendations for various securities, but explicitly states that the advice is impersonal and not tailored to individual needs. The IA sells subscriptions to this newsletter. Based on this information, which of the following is true? A. The IA is exempt from registration under the publisher exclusion. B. The IA must register with the SEC if their assets under management exceed $100 million. C. The IA must register as a broker-dealer because they are recommending securities. D. The IA is exempt from registration only if they do not receive any direct compensation for the newsletter. Answer: A. The IA is exempt from registration under the publisher exclusion. This scenario describes an IA that likely qualifies for the publisher exclusion under the Investment Advisors Act of 1940. This exclusion applies to the publisher of any bona fide newspaper, news magazine, or business or financial publication of general and regular circulation that does not render investment advice based on the specific investment situation of each client. The key is that the advice is impersonal and generally available to the public, despite compensation for the publication. The SEC registration threshold or broker-dealer registration typically applies when personalized advice is provided or when buying/selling securities as a business.